Welcome students. So in the previous class we were talking about the credit analysis of the firms, that how to find out that whether any borrower is worth giving the credit or not. And I discussed with you that we should be looking at the operating structure of the firm and the financial structure of the firm, and we had this detailed discussion also here, that by preparing this format of the income statement, trading and profit and loss account, and then I emphasized upon that we must look at the first your trading part, trading account part, and trading account is the reflection of the operating performance of the firm, because you have 5 items here largely, that is sales and then the closing stock, and then this side we have the 3 inputs, that is direct material, direct labor and direct overheads. So we have to compare these 5 with each other, and maybe with the 2 sides, debit and the credit side. So we will have to see that your net result is, that is the sales minus gross direct expenses is the gross profit, and that gross profit must be intact. That gross profit must be kept safe, or that must be intact, because reason for that is that all the 5 items in the trading account are variable, right. So it means if the cost of input is going up, then the selling price also must go up. Firm must be capable to fetch the increased cost from the customers, and that should be passed on efficiently to the customer. So selling price, increased selling price must reflect the increased input cost. So it means if both the sides are variable, if the cost is going up and sales are also going up, or the selling price is also going up. So we have seen here that your, again I would say that your GP line will be something like this. Maximum it should be like this, that it should remain stable. Either it should have the rising trend, or if it is not, then at least it should be stable. In none of the cases it should be depicting the declining trend. If the GP of the firm is declining, it means you must be careful that the operating performance of the firm is questionable, it is coming down, and that will have the impact upon the financial performance also. And then we talked about the financial structure, which is indicated to us by the lower part of the income statement, that is by the profit and loss account. Here we saw that the net profit, if there is a net profit in the business, then that net profit must be coming from the trading account. First we should have the GP, and then we should have other expenses and incomes, indirect expenses and incomes, and the net result can be the NP, that is before tax, right. But if the reverse is the case, that in the trading account there is a gross loss and in the net profit there is a profit. So it means there is something fishy about it, that this firm, despite being a manufacturing organization, their major source of the revenue and the profit is not the operations but the indirect incomes. So if this income is, for example, I gave you the example of the interest. If it is from the interest income, so it means the surplus funds which the firm had earned when the firm was leader in the market, then the firm is earning interest income out of that, and because of the increased interest income, the gross loss has been converted into the net profit. Or there might be surplus investment which is invested in the buildings, and buildings are rented out now. So rent is coming from the buildings, or huge fixed assets are there which are not being used in the firm but outside the firm as rented out, and huge rent is being earned by the firm. So that rent income is converting the gross loss into the profit. So we would all agree that if there is a interest income which is the source of the profitability, it means this firm is not a finance company. This firm is a manufacturing organization. So major source of the profit must be the operations, and your rent incomes, your interest incomes, they can supplement the profits, but we should start the looking at the profitability from the trading account and from the gross profit. If the trading account is good, is strengthened, is strong, and there is reporting the gross profit, then you can say that the operating structure of the firm is good. And if the operating structure of the firm is good, then certainly even the weak financial structure, currently you might see that their financial structure is very heavy. They have borrowed money from the sources as a loans, which is very, very expensive. So if you have a good operating structure and you are earning a good gross profit, then slowly and steadily those heavy and expensive sources of funds can be replaced with the cheaper sources of the funds at our own priority and the choice. That is possible. But if reverse is the case, that the trading account is reporting a loss and net profit and loss account is reporting a profit, then you can see that the days of the firm are numbered. That a strong financial structure will be killed, will be eaten away by the weak operating structure. So, we will have to make a detailed analysis of the operating structure of the firm and the financial structure of the firm, and the analysis being a manufacturing sector firm, that should be analyzed in the way as we have discussed now, starting from the trading account, moving down to the profit and loss account and finding out what is the source of profitability. Now, apart from your this basic analysis of the income statement, there are certain ratios also which we can use, and we can quickly try to find out something about the operating management or the operating structure of the firm. And there are 3 ratios. We will not put you in trouble by giving you more number of the ratios. Only 3 ratios are enough to evaluate the operating structure of the firm. 3 ratios are enough, they are good enough. If you properly calculate these ratios, you will be able to find out the signals about the operating structure of the firm, and these ratios are: first ratio is fixed assets turnover ratio. Fixed assets turnover ratio. Second ratio is ROI, that is return on investment, and third one is the gross profit ratio. First one is fixed asset turnover ratio. We all understand how we calculate this ratio. This ratio is calculated as net sales divided by the operating fixed assets. Net sales divided by the operating fixed assets. Which are the operating fixed assets, not non-operating fixed assets, right? Say if you talk about if there is a goodwill, for example, that is not a operating fixed asset. So, operating fixed assets are the plant, building, machinery which is in use. So, it means how many times the sales are of the operating fixed assets, and that is a net fixed asset, not gross fixed assets we have to take here. That is the gross assets minus depreciation. So, we will have to find out the ratio, and how to analyze this ratio. Higher the ratio, better it is. Means, for example, this ratio is 2 times in one firm, there is this ratio is 3 times in another firm, this ratio is 4 times in another firm. So, it means the firm which is depicting a ratio 4 times, I think that is considered as a better firm, because their use of the fixed asset is maximum. This ratio indicates the use of the fixed assets, and any firm which is able to maximize its sales in the market by utilizing its fixed assets to the maximum possible extent, that firm is considered as efficient. And if you are utilizing your fixed assets efficiently, manufacturing more, selling more in the market, I am sure that your trading account will be depicting a very strong picture, right. So, this is the one thing that we have to look at. The operating structure means the operations of the firm can be valued or can be evaluated with the help of the relationship between the net sales and the operating fixed assets, and net sales should be, this ratio should be as high as possible. Then we talk about the ROI, return on investment, operating profit divided by the total operating assets. Operating profit divided by the total operating profit is that we are talking about the profit from the operations first, right. We only have to take the profit from the operations, that is not from the interest income, not as a rent income, only the profit from the operations, that is both taking into consideration the direct and indirect expenses. Say if you take only direct expenses, which is only considered in the trading account, then we will be coming to the third ratio, that is GP ratio. But we are talking about the operating profit ratio, so we have to calculate the profit from operations. Profit from operations is only that is from the manufacturing operations in which the firm normally deals, and in that profit, in that revenue, in that income, we will not have to include the indirect incomes. So, we will have to take the direct expenses, direct incomes, and the indirect expenses also, both. So, all the expenses, 3 expenses in the trading account and other indirect expenses in the P&L account, profit and loss account, and then we will have to subtract those from the sales revenue only largely, and no other revenue, that is indirect income, that should be totally excluded. So, operating profit we have to calculate as a ratio of the total operating assets, that is both fixed and the current assets. Total operating assets, fixed and current assets we have to take here. In the upper ratio we are taking only fixed assets, but in the lower ratio we are taking both of total operating assets, that is the both current assets and the fixed assets, and we have to see how many times or what is the percentage. Normally ROI we calculate in terms of the percentage, and fixed asset turnover can be in times, but this return on investment should be calculated in the percentage. So, what is the percentage of the operating profit as compared to the total operating assets, and total operating assets means the fixed assets as well as the current assets. We have to take the total operating assets means fixed assets minus depreciation plus current assets. Then we have the GP ratio. GP ratio is the gross profit ratio. We have discussed at length what is the GP ratio. Here we have to calculate this ratio from the trading account only, because GP is in the trading account. So, from the trading, if you analyze the trading account, you will find out what is the gross profit ratio in the trading account, and taking the GP from the trading account and the net sales from the again from the trading account, we have to calculate the ratio. So, it means we are calculating this ratio at number 3, GP ratio, but the other two ratios are also largely depending upon the third ratio, right, because I told you that operating profit should also be coming from the trading account and net sales should be maximum. So, if the sales are going up, only then the cost should increase, right. In the trading account, when you talk about, we are seeing here that if the sales are going up, if these are the sales, if the sales are going up, only then these three costs have to increase. If this cost is going up, this is depicting a rising trend, but the sales are either stable or depicting a lowering down trend. It means there is something wrong about that. Firm is not that efficient that people are not ready to buy the firm's finished product at the increased price, despite the fact that the cost has increased and firm is simply passing on the increased cost to the buyers. They are not ready to pay the increased price to the firm. So, that is an important questionable issue. So, we should be able to increase the sales, maximize the sales, and as a result of the maximization of the use of the operating fixed assets, we should maximize the sales, and then if the sales are maximum, certainly your operating profit will also be highest, and operating profit will be highest because sales are maximum, operating cost is taken care of, and the gross profit is higher. So, these three ratios, which are normally can be calculated from the trading account and balance sheet, and from the profit and loss account we will have to recalculate the operating profit, because profit and loss account depicts only the net profit before tax, and net profit includes the indirect income or the indirect revenue also. We should be careful about that. We have to subtract the indirect revenue, that is revenue from the rent income, from the interest income as a say commission on some business transactions, or maybe apprentice income, or maybe any other source of say or maybe the dividend on the say investment made in the equities of the other companies. We will have to subtract everything, and then only the sales income, that is a direct revenue, and both direct and indirect cost which are related to the business only, both have to be subtracted. So, the operating profit will be worked out. So, operating management, first you look at the trading account part and how much is the GP, and whether GP is depicting a stable picture or depicting a rising trend. That is the case. If it is a lowering trend, declining trend, not good. So, it should be depicting either the rising trend or the stable trend. This is the first thing from the trading account, and then calculate three important ratios, that is the fixed asset turnover ratio, looking at how quickly or how efficiently we are using the fixed assets, return on investment, that how much return we are generating from this investment we are generating the return on, and GP, that is what is the ratio of the gross profit to the sales, because if the sales are going up, gross profit should also be going up, right. If the sales are going up, gross profit should also be going up. Maximum it can be, as I told you, that it can be stable. So, because if the sales are going up and expenses are also going up, so what will happen? GP will remain stable, that will depict a stable picture or either slightly rising picture. But if the GP is declining, so it means there is something wrong about that, we have to be careful about it. So, make analysis of the trading account and then the three important ratios. Now, we talk about some important ratios for studying the financial structure of the firm. There are a number of ratios which can be used to study the financial structures of the firm, but here for our purpose, the purpose of our discussion, we will only talk about the 3-4 ratios maximum, not more than that, right. So, financial management or the financial structure of the firm, these 3-4 ratios are important here, and if we, apart from studying the profit and loss account and the net profit position, we should calculate and work out some ratios also, so that to understand the financial management part of the company, who is the prospective buyer or the borrower from the seller. So, first ratio is the DE ratio, that is the total debt to equity ratio. Total debt to equity ratio. So, it means for calculating this ratio, we take into account the ratio, that is total outside liabilities to the net worth. Total outside liabilities to the net worth. Now, what do we mean by this ratio here? We have a balance sheet here. I said preparing it in the T form. This is the balance sheet, and we are analyzing this ratio from the liabilities and capital side of the balance sheet. This is your balance sheet, this is the liabilities and capital, and this is the assets, and this is amount. This is the amount, this is the amount, liabilities and capital. So, what the ratio is, that is the total debt to equity ratio. It means we are only talking about the liabilities and capital side of the balance sheet, right. We are talking about the, what the ratio is, say the ratio is total outside liabilities to net worth. Total outside liabilities, total outside liabilities to net worth. First of all, we must be clear about what is the net worth. What is the net worth? Net worth is, there are the two definitions of the net worth. First definition is total assets minus total outside liabilities. Means to finance the total assets this side, total assets here, right, the total amount here. To create this level of the assets, we have invested the funds in the business, and the funds in the business come from the two sources, internal sources and external sources, and total funds become the equal to the total funds invested in the business should be equal to the total assets, right. Now, when you are calculating the net worth, simple way is total assets, total of the balance sheets asset side, total assets minus total outside liabilities or outside sources of the funds. So, you have the long term loans, you have debentures, you have bonds, you have short term loans, you have anything else, or maybe creditors or anything, subtract everything from the total assets. Then what is left with you is, that is called as net worth or NW. Other way around, second way of defining this is that you take the equity capital, or you can say not equity capital, I would say, I will call it as, this is the share capital, because it includes the preference capital also, share capital, sorry, plus the reserves and surplus, that is free reserves and surplus. So, it is also the net worth. Naturally, because in the balance sheet you have the share capital here, then you have the reserves and surplus R&S, that is a free reserve and surplus, which is not having any claim, current claim or the contingent claim against that part. So, this is the first part. Then we have the outside liabilities. Outside liabilities means your long term loans, then you have the debentures, you have bonds, and then you have the short term liabilities, so many things. You subtract total outside funds from the total assets, what is left over is, that is called as net worth. So, either you use the formula total assets minus total outside funds to find out the net worth, or you simply look at the liabilities and capital side of the balance sheet and you see share capital plus free reserves is the net worth. So, first of all you calculate the net worth, and then you see that the ratio, in this case the ratio is, that is the total outside liabilities divided by the net worth. It means indirectly you can say this is the ratio between the insiders funds and outsiders funds invested in the company. Insiders are owners, shareholders, owners, promoters and shareholders, and outsiders are the lenders. So, promoters create a company. When it runs means for the sufficient time and converted into a public limited company, shareholders also give the funds, they subscribe to the shares of the company, so they also give the funds to the company. So, they also become owners. So, promoters plus all the shareholders, they become the owners of the company and they are called as insiders. So, total funds provided by the insiders will be considered, and how much funds are invested by the insiders, and against that how much funds are borrowed from the outside sources as loans or as debentures or as by issuing the bonds or maybe the suppliers credit or other things. Everything we will have to take into account, which will give you an idea that what is the intention of the owners of the business. If because standard ratio we all know that this is the total debt equity ratio, the standard ratio is 2:1. If you invest 1 rupee in the business, you can borrow 2 rupees from the market. This is the standard ratio. It is a standard rule of thumb. In the practice there can be different also. For example, this ratio can be 5:1 even, 6:1 even. That if the company is doing very well, exceedingly well, and financial institutions are satisfied with the performance of the company and they are ready to lend them any amount how much they want, then there is hardly any problem. There is hardly any problem. The ratio can be 5 times, 6 times or any times. But standard is that if you invest 1 rupee from your own pocket as a owner of the company, both promoter and shareholders, then you have the right or you have the expectations you can have from the market, that is you can expect to borrow 2 rupees from the market. Right, you can expect to borrow 2 rupees from the market. So, standard ratio is 2:1. So, it means we will have to see that how much funds are invested by the owners of the company in the company and how much is borrowed from the outside, and then you have to see that what is the ratio between the insider and outsiders funds, because it tells us about the intentions of the owners, whether the owner want to continue with the business or he wanted to just play with the interest of the outsiders, grab the money, declare it as an insolvent business or run away. So, financial management or the financial structure can be studied. What is the proportion if, for example, large investment is coming from the internal sources and only say part of the investment is coming from the external sources, then there is no issue at all, company's financial structure is good, because every say shareholder or the promoter would like that outsiders claim on the company should be minimum, and most of the funds requirements should be met from the internal funds. But if that is not happening, in that case we have to be careful that something is fishy about it. More investment the company is seeking in the form of the borrowed funds, their own investment is very limited. So, it means they do not want to carry on the business for the longer duration. So, we should be carefully thinking about it, right. Similarly, you talk about the short term debt to equity ratio. Short term debt to equity ratio. In the upper ratio, we are taking the total outside liabilities including short term, and in the say second ratio, we are taking into account only current liabilities to net worth, that how much spontaneous finance is available to the firm from its sources. Current liabilities, that is expense credit, and then that is the say bank finance, then it can be the say suppliers credit, all the current liabilities to net worth. Higher the amount of current liabilities, better is the indication, because current liabilities are spontaneous finance. And who gets the spontaneous finance in the market? Who enjoys a very good financial reputation in the market. If the financial reputation of the firm is not good, no supplier will supply the firm on credit, no bank will lend the funds to the firm, and no say workers of the company would wait for their wages to be paid till after even 30 days. They would like that they should be paid every week or every 15 days. So, if this ratio is higher, then we should consider it good, but we should carefully analyze it that after how many times company is paying, or this borrower, this buyer is paying the supplier's claims, how efficient they are in making the payment of the bank loans or the bank funds, and how efficiently means what is the level of happiness of their employees, and how they are utilizing these short term maybe spontaneous sources of the finance. We can collect the information from the suppliers also about the borrower, we can collect the information from the bank also, we can collect the information from the employees also. And if we get the good information that their current liabilities are high, it is a good indication, positive indication, because spontaneous finance extent is high. So, it means you should consider this ratio, and that is the second ratio to study the financial structure of the firm. So, first case, more investment from the internal sources, and or maybe it is a comparable investment from the internal and external sources. Standard ratio is 2:1, but the ratio is higher, then we should be carefully analyzing it. Second ratio is the short term debt to equity ratio, that is the current liabilities to net worth. We have to see higher the ratio better it is, but again carefully the caution here is that we should carefully analyze the ratio. Finished goods inventory turnover ratio, that is another important ratio. Cost of goods sold divided by the finished goods inventory. Finished goods inventory turnover ratio. Cost of goods sold divided by the finished goods inventory. So, how many times the cost of goods sold is as compared to the finished goods inventory? Higher the ratio better it is, because if the denominator is smaller, numerator is bigger, so what indication it gives? It gives indication that the finished goods inventory with the firm is very small. It means most of the production of this borrower is going to the market quickly, and they are not keeping, or they are not bound to keep much of the part as inventory. So, it should be the ratio as higher as possible. Then we have the other issues, days of stock holding, that for how many days the stock is is being kept as stock, finished goods are kept as stock. Means it gives an idea that finished goods are going from the plant to the market, or it is going from the plant to the warehouse. Ratio is finished goods inventory divided by the COGS. So, now what we are doing here, we are converting that ratio, the previous ratio, that this ratio we have reversed it. So, if for example you calculate this cost of goods sold divided by the finished goods inventory. So, we get this ratio that cost of goods sold is say you can see here that cost of goods sold is something like 300s, and the inventory is for example here is say for 30 rupees, 300 rupees the COGS, 30 rupees the inventory. So, what is the ratio? This is 10 times, right. After calculating this ratio, that is the inventory turnover ratio, we have to calculate the next ratio now, then that ratio is reversed, that is the again now we are COGS divided by the finished goods inventory. So, it means this ratio we have already calculated. So, what you have to do is that you have to divide this 365 by 10, and so it means days of stock holding are 36.5. So, on an average for 36.5 days the inventory is staying in the warehouse, finished goods inventory is staying in the warehouse, and maybe whatever the inventory they are keeping, that everything is not going from the plant to the market, part of the inventory is going from the plant to the warehouse, and in the warehouse after the production the inventory is staying, finished goods inventory is staying in the warehouse only for 36.5 days or 37 days. So, we have to now see that we can say how whether it is good or bad, that will depend upon the industry average. You can take the industry average is easily available, that in that particular industry what is the average stock holding days, number of days blocked in the stock. So, we can take the industry average, or we can take the say we can make the comparison with the other similar firms in the market. Not if industry, then 2, 3, 4 more firms you can take the average of those firms in the market. And if this company is for example is on an average performing on an average basis, then I think we should consider that it is a good company. But for example, the company which we are evaluating, their days of the stock holding are higher as compared to the others in the market. So, it gives a feeling that this company is not a good manufacturer, or their product is not liked in the market. So, it means if their stock is not converting into the sales quickly, so you can expect that they will have the liquidity problem, and the suppliers funds can also be get stuck. So, we should be very careful about that. So, compare it with the other firms, compare it with the industry average, and then draw a conclusion that their days of stock holding, whether 30 days, 35, 36, 25, 10 days is acceptable or not. Then is the receivables turnover ratio. With the help of this ratio, means all these ratios are the ratios of the working capital. They are not ratios of the fixed. So, maybe we have the ratios here. For example, we have the ratios like say first ratio was the long term analysis of the funds, that is the debt and equity, but lower is the short term debt and equity ratio, and all these ratios are the working capital. We call these ratios as the working capital ratios, whether it is the inventory turnover ratio, receivables turnover ratio, or debtors collection period. All these are the working capital ratios, and then is the say creditors turnover ratio, creditors payment period, and current ratio. All these ratios are the working capital ratios. So, under financial management, we will have the complete idea about the overall financial performance of the firm, their liquidity position of the firm, and to know whether our investment in this company is safe or not. So, here next ratio is receivables turnover ratio. Receivables turnover ratio is that gross sales divided by the trade receivables. How much of their total sales are on credit? The company who is going to be the borrower from the company who is making the analysis, this ratio is also important, that is gross sales divided by the trade receivables, or you can take here the net sales also, there is no harm in it. Gross sales minus sales returns, you can take the net sales also, and then you can find out the trade receivables divided by the trade receivables means the accounts receivables. So, again the higher the ratio, better it is, because the proportion of the total sales must be very high and the proportion of the credit sales out of the total sales must be very, very low. So, if the gross sales or net sales are very high and credit sales are very low, then certainly this ratio will be very high, right. And next ratio which is related to this receivables turnover ratio is, that is the debtors collection period. As in case of the inventory turnover ratio, we have seen the ratio that we calculated, that first we calculated the inventory turnover ratio and then we calculate the days of the stock holding. Similar is the case here now, that we calculate the receivables turnover ratio and then we say calculate the debtors collection period. Then we calculate the debtors collection period. So, it means gross sales and trade receivables, again we calculate here, that is the say again we take the gross sales are 300 and then the average receivables are 30. So, this ratio is again 10 times, and then you have to reverse the ratio and then divide the 365, that is the number of days in a year, by 10. So, it means again it is the 36.5 days. It means debtors collection period is trade receivables divided by the gross ratio, it is the reverse of that upper ratio, and this period comes out as again 36.5 days, or if you take 360 days a year, then 36 days. So, it means the company who is going to be the prospective buyer from the company who is making analysis, their sales, credit sales are being collected in 35 days. So, it means 35 days is the appropriate credit period in the market. So, their say total sales and proportion of the total sales as a credit sales is acceptable level. So, this ratio is indicating the acceptable level, and that can be as a taken or considered as a good indicator. So, apart from these ratios, these a few ratios about the financial analysis, we have many other ratios also which are given, 3-4 more ratios, not many, 3-4 more ratios we will have to discuss, and then we will have to arrive at the conclusion, say looking at the total financial performance related ratios, both long term and the short term ratios. Largely these are the short term ratios, or you call them as a working capital ratios, and we have discussed till now say 4-5 ratios, and the remaining ratios in the series, or to know about the financial performance of the company, we will discuss in the next class. Thank you very much.